Welcome to Griffonomics.
It's really great to be back today.
Usually when we sit down to do a deep dive into the AI revolution, the conversation goes in one very specific direction. We talk about the brains.
Right, the chips.
Exactly. We talk about NVIDIA or AMD, and we argue about who has the fastest processors and the smartest models.
Which is fair. I mean, that is the engine of the whole movement.
It is. But today, I want to talk about the fuel. Because you can have the fastest Ferrari in the world, but if the gas tank is empty, it's just a very expensive paperweight.
A multi-billion-dollar paperweight, yeah.
So today, we are doing a deep dive into a company that acts as a bridge between the old industrial world and this new AI reality.
And honestly, Bridge might be underselling it a bit. They are basically becoming the landlord for the entire sector.
We're talking about TeraWulf, ticker symbol WULF. Now, I have to be honest with you right off the bat. When I pull up this company's history, my brain immediately goes to Bitcoin miner.
Oh, absolutely. And for a lot of institutional investors, that is a massive red flag. It feels volatile. It feels risky.
Exactly. But the premise of this deep dive is that if you are still labeling TeraWulf as just a crypto miner, you are looking at a photograph from 3 years ago. You are missing the entire movie.
They are undergoing a massive pivot. They're transforming into an institutional-grade landlord for high-performance computing and AI infrastructure.
But is that just marketing spin? Because it feels like anyone with a server rack is claiming they are an AI infrastructure play right now.
No, it is definitely not spin. This pivot addresses the single biggest bottleneck in technology today. It is no longer about how many GPUs you can buy from Jensen Huang. The problem now is, where on earth do you plug them in?
The power crisis.
The power crisis.
Yeah.
Building a data center shell, the actual physical building, is relatively easy. You can throw that up in 18 months.
Right. The concrete and steel part is straightforward.
Exactly. But getting a utility company to actually guarantee you hundreds of megawatts of continuous power, getting the high voltage transmission lines upgraded, that can take 5, 7, maybe 10 years.
So while Microsoft and OpenAI are sprinting, the utility companies are just walking.
And TeraWulf's entire strategy relies on solving that exact problem through a model they call Bring Your Own Generation, or BYOG.
Bring your own generation. It sounds a bit like a potluck dinner. Bring your own guacamole, but obviously the stakes are slightly higher.
Slightly higher, yes. It means they aren't waiting for the grid to slowly come to them. They're going to go between that where the power already exists.
Okay, let's unpack this, because on the surface, this transition from Bitcoin to AI sounds great, but looking at the financials for 2025, well, it's messy. If I look at their revenue mix, 90% of it, about $151 million, still came from Bitcoin.
On paper, yes. If you look at the 2025 rearview mirror, you see a crypto company. But markets price the future, not the past. That AI leasing revenue, it only started in July 2025. It's brand new.
So it's a nascent business segment.
It is, but look at the backlog. They have secured 522 critical IT megawatts.
Wait, 522 megawatts?
Yes, and that represents $12.8 billion in contracted revenue.
$12.8 billion. That is a staggering amount of visibility for a company this size.
It completely changes the narrative.
So help me reconcile this then. If they have this massive AI future completely locked in, why are they still messing around with Bitcoin at all? Why not just shut down the miners and go full speed into AI?
Because construction is incredibly expensive. And this is the real aha moment with their business model. Bitcoin mining uses their existing ASIC fleets to generate cash flow right now.
Oh, so it's the funding engine.
Exactly. It's an ATM. They use the Bitcoin revenue to generate immediate cash flow, which they then pour into the concrete and steel required for the AI data centers.
Which keeps them from having to take on massive debt.
Right. It allows them to fund this high-margin expansion without constantly diluting shareholders or taking on terrifying amounts of high-interest loans.
So Bitcoin is the bridge, not the destination. It is simply a means to an end.
Precisely. It is a very clever use of legacy assets to fund a modern pivot.
Okay, let's get back to the physics of this BYOG model. We established that building power lines takes forever. How is TeraWulf actually bypassing that?
By buying time machines.
Time machines.
In a manner of speaking, yeah. They are acquiring brownfield industrial sites. These are sites that used to be massive industrial facilities like aluminum smelters or coal plants.
Ah, I see. Places that were already guzzling massive amounts of electricity.
Exactly. Let's look at the Hawesville, Kentucky site they acquired in February 2026. It used to be a Century aluminum smelter. Now think about the physics of an aluminum smelter. It is basically a giant, continuous controlled lightning strike.
So the wires going into that property must be incredibly thick.
Huge. We're talking about immediate access to 480 megawatts of power availability. It has high-voltage transmission lines and an on-site energized substation just sitting there.
So instead of waiting 5 years for the local utility to build a substation, they basically just walked in and bought a really big electrical outlet.
They bought the socket and the 250 buildable acres around it. If you tried to permit and build that transmission capacity from scratch today with all the regulatory red tape, good luck.
It's a brilliant workaround. They're recycling the old industrial economy to power the new digital one.
And it gets even more interesting with their second major acquisition in Morgantown, Maryland. This is a beast of a site. It's a former coal plant.
A coal plant. That does not sound very ESG friendly for an AI company.
Well, it's a grid-connected power generation facility. Currently, it has 210 megawatts operational, but the infrastructure there can support up to a full gigawatt.
A gigawatt. We're getting into Back to the Future territory now.
It is massive scale.
Ugh.
And location matters heavily here. Maryland is right next to the PJM market. That is the grid serving the mid-Atlantic, right next door to Northern Virginia, which is the data center capital of the world.
But what about the power drain? Because the big narrative right now is that data centers are stealing your electricity and raising your utility rates.
That is the narrative, yes. But here's the fascinating twist with Morgantown. TeraWulf is implementing a net positive strategy. They plan to build 500 megawatts of new gas-fired generation and 250 megawatts of battery storage right on site.
So they're essentially building their own power plant next to the data center.
Essentially, yes. This allows them to actually support the grid. Imagine it's July, everyone in DC turns on their air conditioning, the grid is stressed. TeraWulf can use their batteries or fire up their generation to shave that peak demand.
Oh, I see. They become an asset to the grid rather than a liability.
Exactly.
So it feels like a crucial political advantage. You're not the villain causing local blackouts. You're actively stabilizing the local infrastructure.
And to pull that off, you need to actually know what you're doing with power. This isn't just real estate development anymore. This is complex electrical engineering.
Which explains the Beowulf E&D acquisition.
Exactly. TeraWulf bought their own infrastructure operator. It brings over 30 years of power generation expertise entirely in-house. These aren't tech guys trying to figure out how a turbine works. These are power experts building data centers.
Okay, so they have the power, they have the expertise. But let's talk about the money. Who is actually signing these leases? I see names like FluidStack and Core42 in the sources.
Right, FluidStack is a cloud platform. They work with big names like Anthropic.
But FluidStack isn't exactly a household name like Microsoft or Amazon. If I'm an investor and I see a $12 billion contract with a smaller company, I get nervous. What if they go bust? What if they can't pay the rent?
That is a very valid fear, and this is where the story gets really interesting. Enter Google.
Google.
This is a critical moat around the entire business. Google is providing credit enhancement for the FluidStack leases.
Credit enhancement. That sounds like banker speak. Can we translate that?
Think of it like this. Imagine your kid wants to rent a really expensive apartment in New York City. The landlord, TeraWulf in this case, looks at your kid, FluidStack, and says, I don't know if you're good for the money. So the landlord asks for a cosigner.
And the cosigner is Google.
The cosigner is Google. And Google is the richest dad on the block. If FluidStack defaults, if they can't pay the rent, Google steps in. Google has the option to either pay a termination fee to make TeraWulf whole, or Google can just assume the lease directly and take over the servers.
So effectively, TeraWulf is renting to Google.
Effectively, yes. It turns a lease with a startup into a lease backed by one of the largest, most creditworthy companies on Earth. It completely changes the risk profile.
And Google isn't just doing this out of the kindness of their heart, right? I see here they are actually stakeholders.
They are deeply aligned. Google holds warrants for 73.5 million shares of TeraWulf stock.
Warrants, meaning they have the right to buy the stock?
Yes. And get this, the exercise price is 1 penny.
1 penny. So they basically were given equity.
It is a strategic partnership. Google wants TeraWulf to succeed because they own a piece of it. And they need TeraWulf to succeed because Google is desperate for that power capacity for their own AI ambitions.
It really de-risks the project. It's not just building a field of dreams and hoping players come. The players are already there and they brought their rich uncle.
That's a great way to put it.
But let's play devil's advocate here. Because if I pull up the financial report for 2025, there is a number on the front page that would make any accountant spit out their coffee. A GAAP net loss of $661.4 million.
The headline number. Yes, the ugly loss myth.
Ugly. It's catastrophic. If I see a $600 million loss on a company of this size, I am thinking they are bleeding out. How do you explain that away?
You have to peel back the layers. This is a classic case where accounting rules obscure the financial reality. Of that $661 million loss, $429.8 million was a non-cash charge.
A non-cash charge.
Yes, it was due to a warrant revaluation.
The Google warrants we just talked about.
Exactly. And this is where it gets paradoxical. Those warrants are listed as a liability on the balance sheet until they are exercised. Because TeraWulf's stock price surged nearly 400% in 2025, the value of those warrants went through the roof.
Okay, I follow.
In accounting terms, if a liability on your books gets more valuable, you have to record that increase as a loss.
Wait, let me get this straight. Their stock did incredibly well. It went up 400%. And because their stock went up, the accountants forced them to report a $500 million loss.
That is exactly what happened. They were punished for winning.
That is wildly counterintuitive.
It is. But the key takeaway for an investor is that $430 million did not leave the bank account. It wasn't cash burned. It was a spreadsheet adjustment.
So if we ignore the spreadsheet magic, what is the true health of the company? Do they actually have the money to build these plants?
They are sitting on a fortress of liquidity. They ended 2025 with $3.7 billion in cash and liquidity.
$3.7 billion.
And their projects are fully funded through completion. They don't need to go out and beg for money in a high interest rate environment. They are flush.
That changes the picture completely. Now let's look at operations. They have this new metric they keep talking about in the sources, critical IT capacity. Why does this matter? Why not just say megawatts?
Because not all megawatts are created equal. Gross megawatts is just how much power comes into the site from the wires. But you lose some of that to cooling, to lighting, to fans. Critical IT capacity is management's North Star. It measures how much of that power actually reaches the servers to do work.
It's a measure of efficiency.
It is a measure of monetized execution. It cuts through the fluff, and they are incredibly efficient. Their PUE, power usage effectiveness, is 1.25.
Is that good?
It is excellent. The industry average is often much higher. It means for every 1.25 watts coming in, 1 watt goes to the computer and only 0.25 goes to cooling.
How are they getting it that low?
Part of it is just geography. Their Lake Mariner site is in upstate New York, right on the shores of Lake Ontario. It's cold up there. They use liquid cooling and the natural climate to keep costs down.
And lower cooling costs mean better margins.
Significantly better. The adjusted HPC segment margins hit 77%, and they are targeting 85% at steady state.
85% margins. That sounds more like a software company than an infrastructure company.
That is the beauty of the landlord model. Once you build the house, the rent is mostly profit, especially when the tenant is paying for the power pass-through.
I also read about a design tweak they made to the new buildings coming online, CB4 and CB5. It seemed like a small detail, but the analysis flagged it as important.
This is a great example of what we call operational alpha. As they were designing these new buildings for 2026, they went back to the drawing board on the electrical engineering. They managed to squeeze an extra 12 megawatts of capacity out of the exact same physical footprint without increasing the construction budget.
And 12 megawatts might not sound like much to the average listener.
In this business, it's massive.
Yeah.
That 12 megawatts unlocks approximately $200 million in extra revenue over the life of the lease.
Just by being smarter with the design.
Essentially free money. It shows they aren't just slapping buildings together, they're optimizing every single square inch.
So, looking ahead, what is the roadmap for 2026 and beyond? Because if they stop building, the growth stops.
They aren't slowing down. They've actually hit the accelerator. They previously targeted deploying 150 megawatts per year. Now they have raised that target to 250 to 500 megawatts per year.
It is aggressive growth.
It is. And they are diversifying regionally. They started in New York. Now they have Kentucky and Maryland. They are entering the PJM market. They aren't just a regional player anymore. They're becoming a national infrastructure platform.
Let's talk about the stock valuation. We touched on this, but how does the broader market view them right now?
This is the frustration and the opportunity for investors. TeraWulf currently trades at a significant discount compared to peers like CoreWeave. We're talking a valuation of around $15.1 million per megawatt, whereas peers are trading significantly higher.
Why the massive discount? Is it just the Bitcoin stigma?
It's perception lag. The market sees the ticker WULF and still thinks Bitcoin miner. Crypto miners trade at much lower multiples than AI infrastructure companies.
So the catalyst here is the re-rating.
Exactly. As they deliver these HPC buildings, CB2, CB3, CB4, and that revenue starts hitting the books, the market will be forced to recategorize them. They aren't a miner that dabbles in AI, they're an HPC pure play that use mining to get started.
It's a branding problem as much as a financial one. But
Right.
usually $12 billion in contracts solves a branding problem pretty quickly.
The backlog usually wins.
So bringing this all together, we have seen a massive transformation here. They took dirty, old industrial sites, aluminum smelters, coal plants, and turned them into the engine room for the AI revolution.
It is the ultimate recycling project, taking the heavy infrastructure of the 20th century and repurposing it for the 21st century.
So what's the final verdict from our deep dive today?
The view from the analysis is clear. It's a buy for the valuation expansion potential. If that re-rating happens, the upside is significant because you are buying AI assets at a crypto discount.
And the risk.
Hold for execution risk. They still have to actually build these things. Construction delays, supply chain issues, those are real, tangible risks. They have to prove they can deliver 500 megawatts a year without stumbling.
But with Google as a backstop, the floor seems pretty solid.
That's the key. Risk defined, portfolio protected.
Risk defined, portfolio protected. I like that. Before we sign off, I want to leave you, the listener, with a final thought to mull over. We've been talking about TeraWulf as a tech play, but think about what they actually own. They own power generation. They own transmission lines. They own land.
It raises an important question.
If power is the new gold in the AI age, and TeraWulf is sitting on gigawatts of capacity with Google as a backstop, are we looking at a tech company or are we looking at a modern-day utility?
And if they are a utility, they are a utility with 85% software margins. That is a dangerous combination.
Definitely something for you to explore on your own. Thanks for listening to Griffonomics.